First point, Fed is independent. Fed is independent. That's a key point. The second point is inflation is a monetary phenomenon. So you can have individual or specific price increases or price decreases depending on a whole variety of things, supply and demand, and so forth. That's not, inflation is a monetary phenomenon. If the dollar were falling rapidly, that would be a signal of inflation. It's not. It's been steady. That's great. Great countries should have a steady, reliable currency, and we do. Only thing I'll say, and it's just my view in general, you've heard this before, more rapid economic growth is not by itself inflationary, okay? More people working and prospering is not inflationary. I mean, for heaven's sakes, we haven't had any cap goods increases in almost 20 years. We haven't had any real wage increases in almost 20 years. We've had some, but very little. If the workforce, which is producing this boom, can't get wage increases, when can they? And how can that be bad? How in the world could that be bad? And I would say how pleased I am that, you know, Chairman Jay Powell has made the same point on a number of times. And that's good. So that's just my view. I'm not interfering with their independence. I just think we're on the same track. I think that's great.
We spoke recently with Jim Bullard from the St. Louis Fed, the president there, and he raised some concerns about the inverted yield curve. And if the Fed continues to raise rates, whether they will go ahead and invert the yield curve, what that might mean. Do you have any concerns about that?
Well, I follow the yield curve, always have. To maybe redefine the original model at the New York Fed, and pardon me, but I can't, the fellow's teaching at RPI, or he was, he spent the New York Fed many years. That model was the yield on 10-year treasuries relative to the 3-month treasury bill. And it's still positive, about 90-ish, 95 basis points or so, something like that. Don't quote me to the nickel, but it's more or less that. That's okay. That's fine. That's not a recession signal. I think the recession probability from that model is very low, 12-ish%, something like that, 13%. So that's pretty good. So using that model, we're fine. That's all I'll say.
Let's talk a little bit about CBO numbers that were put out last week. These are the numbers that are for the first 11 months of the fiscal year through August. They showed that receipts at Treasury were up 1%, but that spending was up 7%. And so as a result, it indicated that the budget deficit would be targeting about $895 billion for that period of time. That's $222 billion ahead of where it was a year ago. Do you have any concerns about the budget deficit, and what would your solution be? Or these numbers?
Actually, this is one of the rare moments when I will publicly agree with the CBO, which is unusual for me. The gap is principally spending too much. I think by a couple of $100 billion increase. The revenues, as you noted, are up slightly, even with the tax cuts. I wish more people would take note of that, and I wish the CBO would talk more about that, because their own estimates from before the tax cuts and after the tax cuts, in other words, roughly mid-2017 and mid-2018, they revised nominal GDP, from which revenues are derived, something on the order of $6 trillion higher, which, using an average tax rate of 17.5% or so, really cut the deficit back by as much as $1 trillion over the 10-year period, which is another way of saying we just about paid, not quite, but we paid for about 2/3 of the total tax cut. And my suspicion is we financed, through growth and this increase in GDP, pretty much financed the business tax cuts. All right? Now, I agree, we spend too much. I absolutely agree. And we're working on it.